If I take the clock back a year ago, your big bet was consumption. 40% of your portfolio alignment was towards consumer directly and indirectly. Now it is oriented towards investment. After 1 year, how will the alignment change?
It depends on one, where the spending in the economy is, where the demand in the economy is, and where valuations have moved in the economy, and where hence there is opportunity. As fund managers, we like to buy into themes where the investment risk is on my side, where valuations are reasonably priced, right? And you get periods like 2007 where everything is expensive and it becomes very hard to find, opportunity at appropriate price. But I don't think the next 36 months is going to be an era where you will get a highly inflated equity market in India. So I believe you will find enough opportunities over the next 36 months to invest at reasonable valuations. Themes may change. So it's going to be a year for stock picking. Like I said, you've got to look ahead and you've got to be a little early in picking the trend rather than late in picking the trend.
How much of a catalyst could be April's credit policy?
Limited, because we think the opportunity to cut rates has become weaker given the high fiscal deficit and the size of the borrowing program. In fact, I belong to the camp where I believe that you will not get a rate cut, because once the first rate cut happens, it's an indication by the RBI that he is now on a path to reduce interest rates. He can't then reverse that direction. My belief is, given the growth momentum in the economy, where we're still growing at 6 to 7%, though the projection for this year is 7.6, I think that's hard to achieve. And given the high fiscal, I doubt whether the Reserve Bank will start the rate cuts in April. So I don't think April will actually make any change to the macroeconomic situation in India.
Let's look at the global big picture and two of the largest economies, US on one side, which has surprised us on the upside, and China on the other side, which is threatening to slow down. So where do we stand? One engine is running and humming, other one is threatening to slow down.
I'm not that optimistic on US growth. And I'm also not as optimistic that China will do as great a job in 2012 as it did in 2009, when the world economy was under stress, simply because of the change in governance that is happening in China.
Personally, are you putting your money where your mouth is, which is you're not investing in alternates, you're investing in equities?
I am predominantly an equity and fixed income investor. I put all my money into IDFC mutual fund products, and very satisfied doing that. I think I've done exceedingly well.
As an investor, not as a CEO?
As an investor.
Okay.
And I'm basically a passive investor, so I'm not an active investor.
But I'm sure you must be getting a lot of queries from your customers that, markets are up 5% in last 3 years, fixed deposits have managed to beat equities, why should I take the risk and then still underperform?
Our biggest endeavor this year has been to produce a series of sales tools that we can share with our advisors and distributors to help them have more sensible conversations with end investors. Because we think financial literacy is exceedingly low. And Game Changers is what we call this initiative, has done very well, because I think at this point of time the distribution industry also needs significant support. It's going through a rough phase. We've got to stand by it, and we've got to partner it in helping them grow the volume of business in a clearly underpenetrated market. And the one reality of the Indian market and of all markets has been that a large amount of flows into risky assets usually happen when the risky assets are fully priced. So if I look at India over the last 10 years and I break up the Indian equity markets into periods of green when it has been cheap, like currently, yellow when it's been neutral, and red when it's been expensive, 92% of flows into Indian equity mutual funds have happened during the red phase, when markets have been expensive. And hence, experience of that investment has not been good. This is also the case for real estate. And I think it may prove also to be the case for gold. So it is a fact that when a particular asset market gets exceedingly expensive is when it attracts the largest quantum of investment. We are trying to get people to look ahead of such cycles and actually invest when the risk of investment is in their favor, when markets are cheap, and have faith that India is a growth story, and in a growth story you will get decent earnings growth of companies, and hence when you buy them when they're cheap you will do much better. So don't have a doomsday in sort of a mindset when markets are looking weak. It all changes, and don't think that the world has suddenly become a nicer place when you have very rich asset prices.
So final question, your fixed income fund manager is of the view that fixed income products will do well, liquidity is tight and Reserve Bank of India will cut rates. Your equity fund manager is of the view that FY13 is the year of equities. Eventually you will get it right.
Okay. I think both of them will, because we are nuancing both of those views. We, on the fixed income side...
smart, you've handled my question.
We're saying is, on the fixed income side, we don't think there's going to be runway cut in interest rates. But we think that the yield curve is inverted, where the short end of the rates are far more expensive than the long-term rates. So we're actually recommending our short-term bond funds and FMPs and medium-term bond funds. We are really not recommending our long-term bond funds. Correct? Because we think that the yield curve will flatten from its inversion rather than the yield curve moving down significantly, and that we may change the view towards the second half of this year depending upon growth. On the equity side, we are clearly saying this is a stock picking year. Put your money into alpha funds. We don't see a runway growth in the indices. We think the indexes will remain range bound for most of the following year, but individual stocks could do remarkably well. So we are hence saying play alpha. So we are neither giving a full-blooded fixed income bull call and saying go buy the longest dated bonds in the marketplace and bond funds. Neither are we saying put all your money into equities because you're going to see 30% appreciation in indices over the next 3 years. Neither. So we are saying play the shorter end of the yield curve on fixed income, buy short-term and medium-term bonds, and play alpha in equity.
I will really appreciate your insights, and glad you could accommodate this interview request.
Always lovely being with you on the program.
Thank you so much.